So in this practice problem, we're going to do a bunch of merchandise purchase and sale transactions. So you'll get some practice switching modes between when you're the purchaser of inventory versus when you're selling inventory. So in this first transaction, we see that on November 4th, we're purchasing merchandise inventory on account from our vendor, Valley Company. It's $8,000, and they're offering some credit terms here, and it's FOB shipping point, which indicates that we're probably going to end up paying for the shipping. But let's just do this first journal entry just to record our purchase of the inventory. So the first thing that we're going to do is we think about what is increasing. Our inventory is increasing, right? Because we're adding $8,000 worth of inventory to our assets. So this is going to be basically a debit to merchandise inventory. And it says that we're purchasing on account. So we're going to basically be creating an account payable to this vendor Valley Company. Remember the credit terms when we're the purchaser, we're going to not assume that we're going to take it. We're only going to account for the credit terms and the discount that we get if we actually pay off this account payable within the time period. In this case, we have 10 days. And if we pay it off within 10 days, we'll get a 1% discount. That's what this 1-10 means. Okay, so again, since it's FOB shipping point, we see here that we're going to be paying the freight bill because basically the seller of this inventory is saying, hey, we're going to take care of the inventory up to the shipping point and then it's on you. So to get the inventory from this shipping point to our warehouse location, we have to pay for that shipping. So it's $160. So basically we know that we're going to pay cash because it didn't say anything about paying on account. So we're going to just assume that our cash is decreasing. So it's going to be a credit. And basically, the way we account for this freight expense when we are the purchaser of inventory is just to basically increase the cost basis of our merchandise inventory. So now we, of course, paid the $8,000 for the actual inventory, but the value of the inventory has to also include this shipping cost. So we're basically going to tack that on. So that's why we're also going to debit merchandise inventory. Okay, so now it's saying that we're returning half of this inventory that we purchased. So what's going to happen is, of course, since we're no longer going to have that inventory, we're going to basically have to decrease our merchandise inventory balance by half the amount. So that's basically 4,000. And we know that we're going to have a $4,000 debit. And so we saw here that we have this payable of 8,000. So clearly, if we're returning half the items, we're not going to still owe Valley Company 8,000. So let's go ahead and decrease this accounts payable. So when we created it, it's a liability, it's a credit, but now we're kind of reducing the amount we owe. And with our system of debits and credits, the way we reduce this liability is by debiting the account. Okay, so now we're switching hats. Now we are the seller of this inventory. So we have kind of a different set of journal entries to think about. So we're selling it for cash and it's giving us the cost of goods sold, and we're given some information about how we've dealt with the shipping. So it's saying first prepare the part of the journal entry for the sales portion of the transaction. Do not record the expense. Okay, so remember for every sales transaction, you're going to have to account for the revenue that you're generating through the sale and also the cost of goods sold, right? Because you're basically holding this inventory, you've paid some amount for it, and then when you sell it, you have to show that as an expense because your inventory is being reduced. And at the time of the sale, you're going to match the revenue from the sale with the expense of how much you paid to get that inventory. Because again, the business of a merchandiser is to buy low and sell high. So you're going to purchase the inventory for some amount, hold it in your inventory, and then when you sell it, you're going to basically record both how much you made by selling it and also how much it originally costed you. And that way you're matching the revenue with the related expense. So it's just asking for the sales portion. So we're going to have a revenue, which is a credit normal account, 1700. And in this case, it's saying that we're selling it for cash. So we're going to increase our cash asset account by 1700. Okay, so now it's saying to take into account this cost of goods sold. Okay, so this basically the 680 is going to be the conversion of this inventory that we have as an asset into an expense because now the item is gone, we've sold it, we've generated some revenue with it. So we have to make sure that our income statement is going to show how much we paid for that inventory. We can't just show this revenue here without the related cost of how much that inventory cost us to first bring in. So we want to match that on the income statement. So this is the time that we're actually going to show an expense for how much we paid for the inventory. So as we know, cost of goods sold is a expense account. So it's going to be a debit normal, 6,800. And what is our credit going to be? Well, basically, as I stated, converting some inventory into an expense because we've now sold that item. So that inventory is no longer an asset for us. We've kind of sold it off to this customer and it's gone. So we no longer have that item in our inventory. So we're going to have to reduce our inventory balance. So that's why we're crediting merchandise inventory. So this next transaction is another sales transaction. It's a little more complicated because we're selling the items on account. So you can see here we've offered some credit terms, 310. So a 3% discount if they pay within 10 days or net end of month. And then we have the cost of goods sold. And then we have some information about the shipping point here. Okay, so our basically the shipping terms. So we're going to begin by preparing the journal entry for the sales portion. So we're going to start off by basically recording the gross amount. So we have this 10,300 sales revenue. And since we're selling it on account, we're going to be creating an account receivable. And it's to this Gunnison Corporation. We're not going to yet account for the credit terms. We're going to deal with that if this customer ends up availing themselves of that discount. So for now, we're just going to record everything on a gross basis. Okay, so now we're just going to account for the cost of goods sold similarly to what we did before. So we will be crediting merchandise inventory and debiting cost of goods sold. And then you can see we're paying the freight bill on this November 10th sale. So if we look back here, you can see that we sold these and the shipping terms were FOB destination. This means that, again, since we are the seller, we've basically, and the shipping terms are that the seller is responsible up to the destination. Since we are the seller in this case, we are paying for the shipping. So we're going to basically have cash, $30. And remember, when we paid for some shipping expense for when we were the purchaser, we increased our inventory balance by the shipping amount. However, in this case, we're wearing a different hat. We are the seller. Okay, so this $30 is actually a expense that we are going to show on our income statement. It's a selling cost. It's a cost we incurred to basically entice our customer to make this purchase. So this is a expense for us in this period because it was basically matched with a revenue because again, we were the seller in this situation. Okay, so we're making another sale on account and all these terms are probably going to come into play later when the customer pays us off. But for now, this is going to be very similar to what we just did above, where we're basically going to create an account receivable and we're going to have some revenue. And we're again going to record it first at the gross amount, so not including the discount because we don't know yet what the customer is going to do. So for now, we're just going to record this revenue at the gross amount, assuming no discount. Okay, so Now we're just going to record the related cost of goods sold, and we're going to credit merchandise inventory. Chapter 6 is all about how this cost of goods sold gets calculated. It's not as straightforward as you think, but for Chapter 5, we're just being told what it is. Okay, so now we have a customer who's paying off the sale from November 4th. Or actually, let's see, paid the amount owed on account from November 4th. So if we look back up, what happened on November 4th? Oh, so this is from our purchase transaction. So if you look back on this day, we made this $8,000 purchase and we created this payable. But you have to really keep in mind that, or rather keep track of the returns, because if you remember, 4 days later, we returned some of it and we actually only owe this Valley company $4,000. So just to look at the T account, we originally had a credit of 8,000 and then we made some returns of 4,000. So at the time that we're paying off this account payable, the current balance is a $4,000 credit balance. So that's how much we're paying off. So just be clear about keeping track of the debits and credits for this account when you are doing these kind of paying off your accounts payable, or even if you make a sale to a customer and they returned some items to you, you have to make sure you're keeping account of what's happening with your accounts payable and receivable, so that you don't forget about the returns that were made. So basically, we know that there's going to be a debit of $4,000 because we want to clear out that T account that I just showed you that had a credit balance of 4,000. But now it's saying that we're taking this discount because remember the credit terms were that we had 10 days to pay it off. So since this is on the 14th, we're paying it on the 10th day. And so we're going to get that discount. And it was 1%. Okay, so the way I like to do this is just to think about how much cash I'm going to actually be paying. Okay, so basically the original amount was 4,000. I'm getting a 1% discount. So I'm only going to pay basically 99% of this $4,000. So 1% of 4,000 is $40. So that's the amount of my discount basically. And so my cash amount is going to be 3,960. Now, if I see here my debits and my credits are not balanced, and to get it to balance, I need to somehow account for this $40 discount. And so what should I do? Basically, when I first recorded this transaction, I assumed a certain cost basis for the inventory. But that's actually not the case because I'm getting this discount. So I need to basically reduce what my holding value of my inventory is because it's not actually the amount I first recorded it because I'm actually paying less. So I'm going to have to reduce my inventory balance by that $40 discount because the inventory balance should always reflect how much net I've paid for that inventory. Okay, so it's gonna, at first I assumed I'm not taking the discount, but now that I am, I want to make sure that my inventory balance isn't overstated. It's not saying that I paid more than I actually did because in the end, the actual economics is I've only paid this much for the inventory. So I want to make sure that the merchandise inventory properly reflects that. So if I quickly just step through all the accounts that, or rather the transactions that affected inventory. We first debited it 8,000 when we first made that purchase. Then we returned 4,000 of it. And so right now it's saying that our holding value of the inventory is 4,000 debit. But now that I'm actually clearing out this account, I want this to actually reflect how much I've paid. Okay, so I didn't actually pay 4,000, right? I'm paying 33,960. So in order to do that, and have my inventory properly reflect that, I'm going to basically have to credit inventory by this 40. So now my inventory is held at $3,960, which is basically the actual cash I paid for that inventory. Okay, so it looks like this Gunnison Corporation was not happy with some aspect of their purchase from our November 11th sale, so they want a $200 allowance. So we basically need to first make it so that they don't owe us as much as they did, because we're basically saying, hey, whatever you owed us, okay, we'll reduce that amount by 200. So we originally created a asset in account receivable, and so if you look back up here, we have this account receivable 10,300. But really they only owe us now 10,100 because we're going to give them an allowance for $200. So we know that we're going to have to basically credit this account receivable to reduce the balance by 200. So I'm just going to put in this credit. And so what is our debit going to be? Now you could say, hey, I recorded a revenue of 10,000, whatever it was, 300, but really I didn't generate this much revenue because basically we didn't actually generate that much sales because we had some this allowance kind of reduced that. So it could make sense, just theoretically speaking, just to debit our sales revenue because now the sale is only 10,100 rather than 10,300. But we have a separate account to basically track all of our sales returns and allowances. So we're going to use this sales returns and allowances, which is a contra account to revenue. And so when we report our income statement, we're going to have the gross sales revenue in that sales revenue account, but it's going to be basically netted against this debit balance in the sales returns and allowances so that we would get like a net kind of sales revenue, which it took into account these returns and allowances. So just to put some numbers in the T count so you can see this. So let's say the original sales revenue, we credited 10,300. With this return, if we wanted to get what our net sales revenue is, we could just have the debit here and then we'd get to 10,100. But we wanted to keep this sales revenue kind of a clean account. We just wanted to have credits. So we're going to basically set up this contra account called sales returns and allowances. And we're going to put this here. And then when we present our income statement, we're basically going to net this credit balance with this debit balance to get a net sales revenue of 10,100. Okay, so now we have another situation where we're going to use the same account sales returns and allowances because in this previous example, we saw an allowance. Now we're going to see a return. Okay, so it's saying that we got some defective inventory as a return. So we're going to have to, again, reduce some of our revenue because we thought we generated this $400 of revenue as part of that previous sale. But really, it was not a real sale because we're just getting it back. So we kind of have to account for that reduction in our actual sales. So we're going to again, use this sales returns and allowances account. And this November 13th sale was related to California company. So they now owe us less money because they're returning some of their items. So we have to reduce that accounts receivable that we created by crediting it. Okay, so that was just half of it because remember when we made that sale, we had two parts of we had two journal entries. We had one related to the revenue and then one related to the cost of goods sold. So we just kind of corrected this part of that sale to account for this return. Now we need to do something to account for this part because some of this inventory is kind of coming back to us. So basically, we're gonna reduce our cost of goods sold because we now kind of are getting that inventory back. And then we're gonna basically use our merchandise inventory and debit it 200. Okay, so now we're switching hats to a purchase of inventory again. So now in these kind of previous, I don't know, 5, 7 transactions, we were the seller. Now we're kind of going back to the same hat we were wearing in that first original transaction when we purchased inventory. We're again now purchasing inventory. So it's going to be on account. So we're going to have basically a increase in our merchandise inventory, and then we're going to have an account payable. Okay. Okay, so now this Gunnison Corporation is paying us off. So we had several kinds of things that were related to them. We had, of course, the return, where they returned, or rather, we gave them an allowance of $200, and then no, the return was for California. So we just had this allowance for Gunnison. Okay, so um, they started off with 10,300. And then we basically reduced this receivable by 200. So they only owe us 10,100. So we know that basically we're going to have to get rid of a credit, or sorry, we're going to have to credit their receivable 10,100, because that was what our debit balance was for this account receivable to them. So that we know this is going to be credited. Now, they're also going to be taking the discount because we offer them some credit terms. So we know that the cash that we're bringing in is not going to be this full 10,100. We know that it's going to be less than that, but how much? Let's see what we offer to them. So we offer them a 310 net end of month, and they did pay us off within those 10 days. So we're basically going to get 97% of 10,100. So you could either do the math by doing, so this is how much cash we're going to bring in, and it's just again 97% times the account receivable kind of gross amount. And then we can also calculate the discount by multiplying the amount that they owed us by 3%. So you can see that the sum of these is going to be equal to the total receivable. Okay, so this is how much cash they're basically going to be giving us. And this is kind of a discount that we are going to have to account for also. Okay, so first let's put in this cash, 9797. And then this discount of 303, we know that it's going to be a debit because to get our credits and debits to equal each other, we're basically going to um, have this as a debit. And then what account should we use? There is actually a special account for sales discounts. So we're going to basically account for that. And sales discounts is also a contra account to revenue. So when again we calculate net revenue, we will account for the discounts that the customers took, we'll account for the returns, and we'll account for the allowances. And so we'll have that kind of gross sales revenue, and then we'll subtract those three things to give us a net sales revenue. Okay, so now paid amount owed on account from November 18th less discount. So this is probably from one of our purchase transactions. So if we go up here, yes, we are going to pay off this account to Rainbow Corporation. So again, we have this account payable, 3,700 credit balance because there's a liability. So I know we're going to have at a minimum $3,700 debit because we want to zero that out. Now, since we're taking the discount, we're actually not going to pay that much cash. So I know we're going to have cash, some amount less than 3,700. And again, since we originally kind of uh, made our inventory this original amount, and we want our inventory to match how much we're actually paying in cash, we're going to have to also account for that by reducing our inventory value by the amount of the discount. So how much cash did we pay? So it looks like they offered us 210. So that means a 2% discount if we paid within 10 days, which we are doing. So if we do 3,700 times 2%, that's how much the discount is. And 98% of it is how much we're paying in cash. So this again is cash. This is the discount. Okay, so again, we have to make sure that we're in the right mindset of whether we are the purchaser or seller of inventory. So remember, when we were the seller, we used the sales discount to account for the discount that our customer took. Now we are the customer, right? In this case, where we purchase inventory. So in that case, we're not going to use that sales discount account because we, as a purchaser, we're recording all those transactions in our merchandise inventory because we were basically accumulating how much we were paying for the inventory as a customer in that merchandise inventory. So you gotta again be very clear about when you are the seller versus when you are the purchaser of inventory, and the accounting treatment is going to be different. Okay, and you have to also keep in mind that you want the merchandise inventory balance to reflect how much you've actually paid, net of any returns or discounts or whatever that you as the buyer have taken. Okay, so in this case, cash amount is 3626, and the amount that we took in a discount is 74, which again is going to reduce this merchandise inventory value. Okay, so now we have to see what happened with California company because they had a return and we offered them a discount because again, we were the seller in this case. So now we're gonna definitely use the sales discount account. We know that they're taking the discount because it's telling us here. And now we also have to see what the net amount was. So if we look back, we can see that there is a return here of 400, and the original amount was 9,000, and we offer them credit terms of 1-15, meaning if they paid us off within 15 days, we'll give them a 1% discount. So they are going to get this discount, and this account receivable is paired with this credit to the account receivable. So the net amount is 9,000 minus 400, which is 8,600. So I know that we're basically going to also have a credit of 8,600 here. Okay, and then we're going to collect some cash from them. They're paying us since we were the seller. So they're not going to pay us this full 8,600. They're going to have some discount on this. It's 1% of this. So it's similar math here where we have 8,600 times 1%. So this is the discount. And to see how much cash they're paying us, it's just 8,600 times 99%. So this is how much cash they're paying us because they're taking that 1% discount. And again, the sum of these is our full 8,600. Okay, and it looks like this is just a pretty simple purchase transaction. We're buying inventory for cash. So we're going to have inventory come in. We're going to have cash go out. And then we also paid some shipping. So we're going to have cash go out. And again, we're wearing the hat of the purchaser of inventory in this case. So we're not going to have delivery expense because we would only use this if we were paying delivery as a part of a sales transaction. But again, since this is part of a purchase transaction, we're going to just add that to the value of our inventory. Okay, so that's it. Hopefully you got a good idea of how to do these purchase and sale transactions. The main thing to keep in mind is that there's a different set of journal entries for when you are the buyer of inventory versus when you're the seller. So just be very clear about that. And also keep track of the returns and allowances so that you know how much your net amount is on your account payable in the case that you're a purchaser, and what the account receivable net balance is when your customer pays you off when you were the seller. And based on those net amounts, you'll calculate the discounts, etc.